How did one VP of Finance bring Macy's to its knees with a $151 million accounting scandal? Here's how I think it all went down. Macy's confirmed this week misreporting of $151 million of small package delivery costs over a 3-year period, starting 2021 Q3. They pinned this on one rogue accountant, covering up an earlier mistake. Is this true? Why would anyone do this? And how did no one pick it up?
Macy's employee responsible for a $151 million accounting scandal made one mistake that snowballed into an intentional cover-up.
Meet Mary. She used to look after Macy's home delivery shipping costs. You know, before the thing happened. At the time, Macy's was spending approximately $1 billion per year on delivering small packages. That's roughly $20 million per week. 5 million packages per week, a $4 average unit cost. Mary's job is to account for those costs as accurately as possible and make sure the costs match the correct month. Macy's year-end is January 31st. Let's take an example. By the time Mary needs to close the books in the first week of February, Macy's might have received invoices for shipping up until the middle of January. She then needs to book an estimate of the costs for shipments made but not yet invoiced. This would be treated as an accrued expense. In this example, the accrual for January was $35 million, which is the red area on the chart. The value of costs of packages shipped but not yet invoiced.
Image. The graph shows daily small package shipping costs throughout January, with blue bars representing actual invoices received and red areas representing estimated costs for uninvoiced shipments. Around January 14th, there's a transition from mostly invoiced costs, blue, to mostly accrued uninvoiced costs, red, with the total accrued amount reaching $35 million by month end.
Mary calls Phil in procurement. His job is to get the best shipping rates and deal with the carriers. Phil confirms the number of packs sent during January. Mary ensures that she has captured all cost via either an invoice or an estimate of costs for shipment costs not yet invoiced. Mary does this each month, and by talking to Phil, she makes sure nothing gets missed. Occasionally, there is a change of carrier or a special rate, and it's this regular dialogue that ensures it doesn't get missed. And crucially, the expense gets booked in the correct month. By now, Mary and Phil have this down pat. Mary starts to automate her process. Phil helps her get live automatic data feeds from the carriers so she knows exactly how many units of each package type has been shipped. With that, she can calculate the correct expense each month. Compare that to the invoices that have been processed for the period and accrue the rest. Mary does a good job and gets promoted elsewhere in the business. She hands over to Mark. Because of the work Mary did automating, Mark ends up with additional responsibilities packaged into his role. He will look after other expenses in addition to shipment costs. Mark doesn't take the time to understand the shipping expense or where the numbers come from. Mary had things figured out, so he'll just copy what she did. So I just gotta accrue the number in that cell of the spreadsheet each month. Got it. This works fine for a while. Until we reach 2021, shipping volumes are up as the world is more online than before. And thanks to inflation, the costs have started to rise. Shipping now costs $4.50 on average. To combat this, Phil introduces a third package size, medium. Phil doesn't mention it to finance because he wasn't sure who replaced Mary. Whoever it is never bothers picking up the phone to him like Mary used to anyway. They must have it in hand. But Mark's spreadsheet feed doesn't pick up the new medium package size, meaning he is missing all of the medium shipment quantities in his end-of-period cost estimate. Meanwhile, Mark is just blindly posting based on that model, which is no longer fit for purpose. The invoices are still rolling in, including the medium shipments. Suppliers got to get paid. And as the real costs and volumes are rising, this number is going up. while his modelled expense is rising more slowly as it's missing the volume and price for medium shipments. We are now in 2021 Q3, and Mark is starting to unknowingly produce misstated accounts. This is stage 1 of the whole catastrophe. Note, this kind of mistake happens all the time in nearly every large finance team, so it's poor but not unusual. Where this situation is unusual is in what comes next. At this stage, the error is only approximately 0.2% of annual shipment cost spent. His under-accrual could easily be corrected the next month, but Mark doesn't pick it up, and continues to repeat the mistake each month. Mark's boss doesn't pick it up either. He's the controller for the home delivery team, responsible for reviewing the department balance sheet each month. He has 100+ balance sheet accounts to review. This account has never been a problem before, so he doesn't give it much time. I've grossly simplified things. In real life, there would not just be 2 or 3 shipping rates, there would be dozens or maybe even hundreds. Multiple carriers, regions, package sizes. A giant grid of costs, constantly moving, especially through high inflation. And in a big, complex business, this information could be scattered between several people, sources. Honestly, you would be shocked at how shit the information quality is in big, mature corporates. You can see how Mary's original model could get stale fast. Ensuring the model stays live is a key part of Mark's job. Probably the most key, but as he hasn't invested time in understanding how this all works, it just passes him by. Meanwhile, a serious disconnect is growing between the real cost of shipping and the reported cost of shipping. The numbers look good. Phil is getting a pat on the back from the exec for doing a good job in bringing shipping costs down as a % of sales in an inflating market. Everyone is happy, so no one asks too many questions. The commercial and merchandise teams are getting scorched each week by the exec for their poor margins and soft sales. The home delivery team are glad it's not them. So keep their heads down while the false numbers are good. 2022 feels plain sailing too for the home delivery team. They continue to report numbers close to or in line with a budget. Meanwhile, a disaster is building as there is now a $30 million hole building on Mark's balance sheet that no one has spotted. But also the actual run rate of cost is approximately $30 million per annum higher than anyone thinks and is set in the budget. This means that not only are the actual earnings being reported to Wall St incorrectly, but so is the future guidance as the business is oblivious to the growth in shipping costs, and the gap is growing. By the end of 2022, Mark notices something weird. That accrual he is posting each month for uninvoiced shipments during the month is starting to turn negative, a negative accrual, i.e. a prepaid expense. That can't be right, he thinks. There must be some invoices that need accruing for. They can't all have been received already. He figures he should look into it. Mark does a deep dive and spot checks some invoices versus his model, and he finally picks up the phone to Phil to clarify his numbers. Phil points out his model is missing the medium package size he added 12 months ago. Mark just discovered his mistake. Gulp. He quickly quantifies the rough size of it at $30 million and growing by $1 million per week. This is stage 2 of the fraud. Now he's aware. His heart rate hits 180 BPM instantly. He runs to the restroom and pukes up his lunch. How does he tell his controller? He is ashamed, embarrassed, and worried about losing his job. Phil mentions he was hoping to get rates down soon. Mark figures if he can hold out, he can use those savings to square off his balance sheet position. He chooses secrecy. 3 months later, and inflation is still rampant. Shipping rates are going up, not down, and so are volumes. Now the $30 million has grown to $50 million, and the reported expense bears no resemblance to the actual expense. Mark can't sleep and loses £20 in 3 months. $50 million is too big not to get picked up by his VP of Finance. So to avoid detection, he starts to chop the $50 million up and scatter it into different balance sheet accounts. Mark's in deep now. Stage 3. Mark is now actively concealing his error. Meanwhile, the gap between reality and the accounts gets wider. Shipping costs keep growing. But the accounts don't say that. The exec are too focused on crises in other parts of the business to look further into something that seems under control. Mark is still hopeful that he will get a chance to reset expectations and build a balance sheet surplus somewhere else to offset his issue and clear this up. Maybe he can use one of his other expense lines. He's delusional. Meanwhile, the gap keeps growing. By the end of 2024, this thing has grown to $151 million. That means the real small package costs have been an average of approximately $50 million per year, higher than Mark has reported into the business over the last 3 years. Naughty Mark. Mark's VP of Finance, the controller's boss, gets a call from the corporate team. Hey, working capital has grown by approximately $200 million in your part of the business over the last 3 years. The net accrual has moved from $500 million to $300 million. Any idea why? We have Q3 earnings next week. Mark's VP of Finance asks the controller, and he doesn't know either. So the controller does an account-by-account review of $200 million move to see where it sits. It quickly becomes clear $150 million of it sits in the balance sheet codes Mark is responsible for. The controller finally does some spot check on the balance sheet reconciliations she's been signing off for years. She finds a $4 million cost posted to the balance sheet that doesn't make sense. Maybe it's just some timing difference that Mark is cleaning through next month. But quickly she finds 3 or 4 more. Now she is starting to panic. She brings her VP of Finance into the loop, who immediately picks up the phone to the internal audit team and asks them to take a look at it. The controller briefs Mark that audit are coming to review some unusual postings on his balance sheet. Mark knows the game is up. He pukes in the restroom again, then goes home for the day. The audit quickly unravels that there is a major issue. All eyes turn on Mark. It becomes clear that he has been the architect of a major accounting error and subsequent cover-up. But he's not the only one who has messed up. Everyone is puking. The audit team, controller, and VP of Finance meet, and they could not be faster to pin this all on Mark. He's always been secretive, but we thought he knew what he saw doing. I did notice he hasn't been himself. Come to think of it, he has lost a lot of weight. If he's been deliberately hiding this from us, it's impossible to pick up. All 3 know they have dropped the ball too. Their job is to make sure things like this don't happen. The controller and VP know that this has played out right under their noses. But it's convenient for everyone that all of the spotlight is placed on Mark. So that's the story that goes up the chain. The CFO loses the plot when they hear, and so does the CEO. They are the ones to explain to the board, and then the investors. It will delay the earnings report. But it's also convenient for them to pin this all on one person. A rogue accountant is an isolated issue. It's painful and embarrassing, but containable. But a story that their balance sheet review controls haven't been working as they thought is not containable. It asks much wider questions, and not of Mark, of the management of Macy's and its whole control framework. That would be bad. The exec and board all rushed to highlight that one time when they said, we should have a deeper look at shipping costs. It's CYA time. I knew something was up. They didn't. But it helps them keep a safe distance from the shit grenade. The VP of Finance gets called to an emergency audit committee meeting. There is shock at the negligence. The CFO is dragged over the coals by the board. Your team confirmed there are 4 eyes on every balance sheet each Q. What else is your team telling us that isn't true? The VP of Finance and Controller's reputation inside Macy's is ruined. But it will happen quietly. They are either fired or managed out over time, but Mark will be the public fall guy. His career as an accountant is over. The CEO commits to Wall Street that there will be a review of controls, and the world keeps turning. And that's my best guess at how it all happened. Disclaimer: I have no information on this whatsoever other than what is in the public domain. So this is a totally fictional account filling in the gaps between the public disclosures. And for those asking about the external auditors, Macy's EBITDA was $7 billion in total over the affected period, so the misstatement is about 2% of EBITDA. The audit is not there to detect that sort of size of issue. They typically set their materiality threshold at 5 to 10% of EBITDA. That said, it would have become material in the last year. Macy's performance has been horrible, so audit materiality would have fallen with EBITDA, and the cumulative size of the misstatement has grown. This twin effect is probably contributed to it being detected when it was. Accounts payable and accrued expenses are typically about $3 billion in Macy's. So at its peak, the fraud reached a 5% misstatement of total AP and accrued expenses. Emo, this is more a management issue than an external audit issue, although it's not a great look for anyone. I have seen things like this before, and the middle part of the story happens in large corporate all the time. In big complex organizations, knowing your accruals are complete and accurate can be extremely hard. There are so many cooks in the kitchen, and things change all the time. Ex-department communication is often awful, but that is no excuse. That is why controllers and VP of finance exist, to spot things that look weird, point at them, and ask why. In a functioning finance team, that happens after month 1, 2, or 3. This whole thing gets detected when it's less than $5 million. The accounts get quietly restated the next month. No one will even notice $5 million. Mark gets fired. The team reviews its accrual methodology, strengthens its reviews, and moves on. That it started is not unusual. I've seen the first few scenes of this movie more times than I can remember. I clear shit like this up for a living. That is when 3 years without detection and was allowed to quietly explode is what makes it unusual.